Hello, welcome back. We're on day 2 of Precious Metal Summit in Beaver Creek, and I'm with Fred Bell, the CEO of Elemental Altus Royalties. Fred, good to be with you again.
Thank you for having me here, Peter.
Look, it's been 12 months. We were sat here this time last year. Why don't we just kickstart things? What's happened in the last 12 months since we've had a chat?
So look, I think we're September now, 2024, and really what we've started to deliver as a company, I think, is really that free cash flow growth and deleveraging. And so if you look at the course of this year, we started it with a $30 million drawn amount on the credit facility, and we have paid down $5 million in Q1, we've paid down $5 million in Q2. I think we can continue that cadence of paying down the debt. At the same time as that, using our free cash flow, we've been able to make a new acquisition over the summer of the Mactung tungsten royalty in Canada. It's part of Far West Metals, a Lundin company. It's a very strategic mineral nowadays, and I think DOD and US bodies are looking to support development. And this is a project that had 6 or 7 years of permitting historically. So it's a project that's done a huge amount of the legwork. And for us, it reminded us in some ways of one of our early royalties, TSXV-ELE, which was a mineral sands royalty. It wasn't gold or gold copper, our sort of primary focus, but we thought it was a really good value buy. And I think in this case, we thought this is a really good value buy on a quality project in Canada with a good operator as the owner. So from that perspective, I think we haven't done a fundraise now for 19 months. We haven't needed to. We've spent 13 million this year, both reducing the debt and making new acquisitions. We have 7 million in the bank. We're cash flow positive. It will be record revenue in 2024. It should be record revenue going into 2025, with our Diba royalty starting to produce in Q4. Well, actually starting to produce now, but going into Q4. So from that perspective, we have record revenue, free cash flow, lower debt. We're in a position where we don't have to do an external fundraise, and I think in terms of our share price, we've just come off recent all-time lows. Yeah. So from that perspective, I think today we're representing the best value we ever have been as a public company, and we're not talking about the rest of the 60 royalties in the portfolio and any value there.
Oh, what a year, eh? No, I think well done on paying down the debt as much as you have. So it sounds like by this time, or potentially the next year, you're paying down what, 5 million a quarter?
Look, we didn't touch on sort of call it $15 million of one-off payments we will get over the next, I think probably 9 to 12 months. So realistically, by summer, mid next year, we could be debt free if we want to, with a up to $50 million credit facility, and also talking about 20-25 million US of revenue. And so, look, a really, really strong position. We've got a lot of organic growth in the portfolio, both this year, going into next year, and then going into 2026. So I think it puts us in a great position, continue to grow even if we don't do anything. It's never been the case in the history of the company, but also really importantly, we've been able to start doing things from cash flow.
Yeah, well, this is one of the key issues with a lot of the junior royalty space, is that the amount of debt that a lot of these companies, your peers, are in, and the interest on that is a real burden. And I think the fact that you're going to be pretty much out of that within 9 months is phenomenal. Talk to me a little bit about guiding, because you mentioned around 20-25 million, but from memory you were doing that at a much lower gold price, right? So would it be right to assume that potentially guidance could be a bit higher next year?
So look, we used GEOs, gold equivalent ounces, and we used a approximate $2,000 gold price, and I think we used a 390 copper price or 375 copper price. So clearly we are pretty directly tied to commodity prices. Yep. And I think that's a bit of a moving target. I think at the end of last year, when we looked long-term gold price, we were using 1650 or 1800. Yeah. And if you talk about that in today's environment, that feels far too conservative. And sort of looking at those. So clearly, what we can control is giving our shareholders as much exposure to ounces in the ground, and then depending on where commodity prices are, we'll benefit. But for us, the key part of it is that I think we're looking at $5.5-6 million US of sort of G&A as the target for this year, and we've really slimmed down the team, and we've kept a focus on costs, so that now if we are getting an extra $2 to $5 million of revenue a year, that $2 to $5 million has no cost associated with it.
Yep.
So it is directly free cash flow. If we do a deal tomorrow and bring in another $5 to $10 million of revenue, that is all free cash flow. So we're at that point now where we can really start to layer on growth and importantly free cash flow growth, which is something we've talked about, I think, ever since we did the merger with Altus, and even before that as Elemental in the company. So I think combined the teams have done a really good job to get us to a point today where it's, I think, the equity markets for junior companies have not been so supportive, but we've been able to continue to grow and also improve our financial position organically.
Why is there such a big disconnect between your share price and obviously what you're doing? It sounds like this time next year you're going to be debt free. You've got one of the lowest G&As in the industry. In terms of your peer group, your actual revenue profile is actually very, very good as well. This is going to be a very profitable business, and like you said, you've now got some options for growth as well. You've got the credit facility, you've got free cash flow. Look, I know it's always hard to ask this question,
yes.
but what's it down to in your opinion?
Look, I think it's partly it is. I think we're not the only, call it, sub $500 million company in the junior gold space. If you consider us a majority gold company, we're not the only company in that space that has seen the share price erode.
Yep.
And if you take the royalty space in particular, it's interesting. Since the beginning of this year, you've seen the gold price go up, say, 20%, and you've seen that reflected in some of the major and the mid-tier royalty companies. But if you go to the junior royalty space, who are actually more leveraged, more exposed to the gold price, there's been a disconnect in that the share prices have been flat or down, while the gold price, the commodity price, has gone up. And I think ultimately that comes down to that investment driving commodity price forward is not the same investment that's going into the junior mining space. And I think that is partly driven by liquidity and awareness. And if I look at the gold price going up 20% and I'm an average investor, I might never hear about an Elemental Altus. So you might not even know that there's a company there and have the ability to do it. So I think scale is key.
How much does, because I think as well, one of the things for the junior royalty space is, I think people get excited by the idea of consolidation or even M&A with some of the bigger guys. How much are you still able to do that with a group like the Mancha being so heavily involved at the moment?
We've been on the record as saying we support M&A and would be very keen to find ways to progress that. Look, from our position, I think there are a number of companies in the sub-billion space that have a combination of really attractive, good quality assets and revenue and management teams and shareholders. And someone here at the conference actually made the point to us yesterday that if you were to put us and one other smaller royalty company together, I think we would be 10% of the market cap of the intermediates on average, but 30% of the revenue. So we've got 30% of their revenue, but 10% of the valuation. So clearly there is a lot of value that could be created by doing some of this, but it's never straightforward because you're dealing with a lot of stakeholders on counterparties, shareholders, boards, directors, and in an environment where the share price, which is your currency, is constantly moving. So
would it be fair to say as well, like you mentioned, a lot of these junior, especially the junior royalty space, a lot of them are actually near all-time lows. So who wants to do a deal whilst they are at these levels?
Look, the good thing I would say is that it's when you're doing an all-equity deal, it's all relative. And so if you've got two companies that were at $2 and they're both at $1.50, actually they're going to own exactly the same proportion of the company.
Exactly.
And so I think that for M&A, when it's a sort of merger approach, actually the bottom of the market is when it's a time to do it. The best time to do M&A is now, because I think that some of these companies are really undervalued, and in the junior royalty space, I mean you can see it in terms of some of the quality of the assets and the revenue and the valuations. And I think if you're putting them together, those two companies have actually probably traded relatively similarly and are going to own a relatively similar amount of the company, but you're going to put yourself in a position where you are much more relevant to investors.
Well, there's that, and there's also the amount of G&A spread over two companies, when you could just combine the two, cut the G&A in half, essentially. The margins are going to be much better.
And look, there was, I think if you look at a number of the junior royalty companies across the mining space. If you looked at last year, for example, I think a group of numbers not precise, but sort of 8 companies had combined 75 million of revenue, but 65 million of G&A.
Yeah.
Now, in reality, if you put those companies together and you said it had 15 million of G&A and 16 million,
potentially wouldn't even need that much, yeah.
it would be a very different story, but it would also have probably the liquidity, the diversification, scale, and critical mass. So it doesn't have to be an exact science, but the principle still stands. And actually, I think it holds more water. It is more rational. It has more value upside when you're in a difficult market and when junior equities are not getting anywhere near the same attention that the larger equities are. And the capital inflows are going into the indices and they're going into the big, well-known liquid names. And that hasn't flowed through to the junior space. Now, maybe with M&A increasing, maybe it will. And there's been, over the last 2 months, a number of material M&A transactions announced, particularly in the gold space. But that, again, sometimes that is a driver of increasing liquidity and interest in the junior space as people start to see the value disconnect and they see the big companies have moved and the smaller haven't. And if that remains the case, either it has to close or the smaller companies are going to be the target for M&A by the larger companies.
Yeah, and I think considering the fact that potentially you're going to be debt-free this time next year, and the cash flow, the model that you're explaining is improving year on year, I think you'd be pretty attractive to quite a few different companies. But why don't we talk a little bit about DEBA, because that was always a project that I quite liked when it was under Altus Strategies. So what's been going on there? Because I think there's been a few different press releases this year, and I think it would be quite good to clear the air as to what the actual situation is.
Yeah, look, the Altus team did a really good job advancing that project and taking it forward, and keeping it on a relatively low budget. And the deal that we announced last year with Allied Gold, who operate the adjacent Sadiola mine, it does 150 to 200,000 ounces a year of production and has been in operation for many years. That was to fast track those assets into production. And these are 10 to 15 kilometres away by road. Allied have, since that deal was announced in the second half of last year, they have built the haul road to site. They have already started the open pit. They have declared a maiden reserve. They have increased the size of the resource. They have announced they're doing more exploration there. And the one, I think the guidance from Allied earlier this year was that they would start getting into production in mid-year. Okay. And I think that one of the key discussion points for them at the time was permitting with the government and turning this into a mining license. And so there was an announcement a week ago by Allied that they have come to an agreement on that, which is really key catalyst for us because it enables them to start mining the project. And this is a project that we have a 3% royalty on. So for the first 226,000 ounces, it is one of our highest royalties by exposure. So it should be a really material contributor to the company from Q4 this year, but then for a full year next year. Okay. And so look, very good to see Allied progressing that. They have done so much more work and invested so much more than we would ever have been able to. Yeah. And the fact that they have the mine, directly adjacent, it's a really good example of being able to take a project and put it into really strong hands. And I think there's a lot of upside for us there on the royalty, but also for Allied. And we're going to benefit through the royalty. Mm-hmm. And obviously they're going to manage the project and run it, and I think grow it over time.
And where do these, just moving on from DEBA, but where do these, you mentioned a 10 million payment that you're expecting next summer. I think in total there's 15 one-off payments. 15 million in one-off payments. So where's that come from? When are these expected to be due?
Yeah, there's a combination of payments. There's, I think, another $4 to $5 million in payments associated with production at DEBA. Okay. So commercial production, there's a payment. Production of 100,000 ounces, there's a payment. We also have a buy down on one of our royalties that expires middle of next year. With approximately $1.5 million that I think we're expecting that will be exercised. And then we have the really material payment in Q2 next year is about $10 million US that is related to the Ming stream that we had and the buy down of that, or the repayment for that. So look, in addition to our revenue, we're going to get some pretty material payments from a combination of sources over the coming 12 months. And that will, there's no cost associated with that. So that all comes straight through. And I think that strengthens our balance sheet even more. So, I mean, financially, we've never been in a stronger position than we have today. And if you look back at when we started the company, and we had, I think, year one, $400,000 of revenue, and we're now talking to a position where, you know, the portfolio is growing organically by maybe $3 million plus going into next year. And that's not taking spot gold prices. You know, there's a lot of growth there into 25 and 26, but we also have the money now organically to deploy into new acquisitions. And I think those new acquisitions and doing deals, I think that is probably also going to be important for the share price and shareholders to see it growing.
Yeah, no, agreed.
And that sort of inflection point where you go from having $30 million of debt and small margins to having cleared all the debt and actually having more free cash flow than you've ever had and growth in the portfolio, that's going to be a really key point for the company.
No, it's exciting. And I guess to wrap this up, obviously you're talking about looking forward to acquisitions. You have done obviously the recent deal on the tungsten project. I think that's more development stage though, isn't it?
Yes.
Does this now free you up to start looking at more development, exploration stage assets, build up that pipeline, or is the focus still going to remain on producing assets?
It's a good question, both.
Yeah.
So last year we did producing assets, we did development assets, we did the range. Prior to last year, I would say we have probably really focused on almost exclusively producing assets.
Yeah.
Last year was the first time we started to layer in development assets. And if you look at the Altus royalty with Arizona and Sonoran we bought last year, I think from when we acquired that, increase in resources there and reserves, I think metal content in the reserves has increased 3 times since we acquired the royalty. So you get some really good resource growth there and exposure to that when you buy into a development project, but with the caveat that it's going to be a longer lead time to production. But we're in the fortunate position in we have revenue growth in the portfolio and we have a lot of money coming in through that. And so for us, I think look, that puts us in a really good position to look at both development assets and producing assets going forwards.
Last question. I guess this time next year, so we're sitting same spot, Beaver Creek. Would you rather be able to tell me this time next year that there's been some M&A and you've combined with another company and you're getting that scale? Would you rather be able to tell me that you've done a few more acquisitions and pay down obviously the paying down the debt's going to happen anyway by the sounds of it, but do some more internal acquisitions?
Well, if you're giving me the choice, I'll say both. I think that look, there's so much value to be added through accretive, sensible M&A, but that should never stop you doing the call it the ongoing cadence of regular transactions and growth. And I think if you can do an M&A deal, it's only going to give you greater ability to do more deals. Yeah. So I think, look, we're definitely going to be looking at new acquisitions, and then M&A, you can never put an exact timing on it. But I think that, and that's my view, but I think that the general consensus amongst companies and investors in the junior royalty space is an increasing view, if it wasn't there already, that some sensible working together and consolidation is probably going to be really value accretive for all involved.
Music's my ears. Fred, thank you for coming back on.
Thank you, Peter.
Thank you.
Good to see you.